What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are going to be looking at the difference between monetary policy and fiscal policy, what the differences are, and why it seems like they are on a track to kind of converge and merge into one and the same thing. Let's dive in. Over the last few hundred years, our world has developed into a system where you have a government that is a centralized controlling government over a nation, and then usually in that nation there is a separate entity that is a central bank, and they are the central controlling power, if you will, of the financial system. They're usually two separate entities. Now, depending on the country and depending on the time, the relationship and who controls who has varied from one place to another. In the United States and in most countries around the world today, we have a system where, yes, the federal government or the centralized government that is in control of the whole country is technically in control of the central bank, but there is still some separation. Usually the central banks operate making their own decisions within the path that has been allowed for them to operate in by that central government. Now, in terms of U.S. history, the Founding Fathers never wanted there to be a central bank. They had all experienced the hyperinflation during the Revolutionary War from the Continentals when a central bank was able to print money. And so that's why in the Constitution they said that the federal government only had the power to coin money, because they had experienced paper money, so they said money is metal and that's it, because they wanted restrictions on what the government could do. Now, most people aren't aware of this, but there were 3 attempts at having a central bank before the Federal Reserve was started in 1913. Now, obviously, those first 3 attempts all failed until the last attempt, the 4th attempt in 1913, stuck. Now, the Federal Reserve was given 2 mandates by Congress. The first mandate was stable prices, and the second mandate was full employment. Now, when you have a quasi-government entity that has a monopoly, a legal monopoly on printing money, they are the bank of banks, there are obviously going to be some concerns, specifically concerns about moral hazard. And so there were some limitations put in place on what the central bank could do. Number 1, they had to keep a certain number of ounces of gold in reserves as a ratio of the actual paper that they had printed. This would ensure that they couldn't just print and print and print till their heart's content, triggering hyperinflation. They could only print up to a maximum, so that if a certain percentage, usually it was 40% of the dollars were redeemed, were sent in for redemption of the gold, they had about 40% of the gold in reserves in order to redeem those dollars. And if you look at pictures, or maybe you have some in your collection of any of these original Federal Reserve notes, they said basically that if you turn this in, you'll get $20. Like a $20 bill said, if you turn this in, you'll get $20, because a dollar was defined as a weight of gold. And so in that case, it was 1 ounce. And so it was a note, it was an IOU. If you turn this in, you get metal back. And so when the Federal Reserve was started, their main tool was interest rates, and they would try and seek stable prices and full employment through their manipulation of interest rates. Instead of letting the market set interest rates, they would do that themselves. Now, interest rates, the definition of interest rates, you can think of them as the cost of capital, the cost of money. And so the cost, if money is stable, then the cost of money is a signal for the rest of the economy. It'll tell you, hey, expectations are for inflation or deflation, or capital is expensive right now. It helps entrepreneurs and businesses make decisions about how to deploy their capital, whether they should be saving for a rainy day, whether they should be investing aggressively for growth for the future. But now, once the Federal Reserve started, we had a centralized control system to try and manipulate the cost of capital. That distorts the price signals, so people couldn't anymore reliably use interest rates as a signal for making capital investments or saving or investing, because it wasn't the market setting that as expectations. It was a centralized control moving it up and down with the goal of making prices stable. Well, within 7 years, we had the greatest depression this country had ever seen. From 1913 was when they started. 7 years later, in 1920, we had the depression of 1920 to 21. Now, luckily for the people at that time, the federal government decided to do nothing. The Federal Reserve relied on more traditional economics, and they actually raised rates even though there was a depression. It was painful, but then it resolved itself within 18 months. There had been an artificial boom due to credit distortions, and so then the depression fixed that. Well, 10 years after that, same story repeated itself due to artificial manipulation of the money supply through interest rates. We had another massive credit boom that led to the Great Depression, and this time the federal government didn't stay out of it. During the Depression of 1920, Herbert Hoover said, hey, if I'm ever in power during something like that, I'm going to do this and this and this and this to try and make it as painless as possible for people. Well, he got his chance. He was in power during what we now call the Great Depression, and he unloaded a whole list of government interventions. Now, FDR was campaigning at that time, and he was actually saying that, hey, Hoover should not be doing this. We shouldn't have all this government intervention. We shouldn't have all this government spending. He's handling this poorly. He should stay out of this. This was the first time that government had intervened during an economic crisis or a panic or a depression. It was unprecedented. The government had completely stayed out of that. It wasn't their job, or nobody thought it was their job, at least before Hoover started to intervene. And FDR was saying, hey, we need to be more free markets about this. We need to pull back. So on the campaign trail, he was saying, Hoover, it's the exact opposite of what the history textbooks tell us today. Hoover was not kind of laissez-faire about this. Hoover was intervening. FDR was saying, hey, that's bad. But then as soon as FDR got into office, he doubled or tripled down on everything that Hoover had been doing. Very, very, very similar story, if you fast forward today, to the Trump campaigning during the Obama administration. Trump campaigning, he was saying, hey, everything Obama is doing is creating a false bubble. it's manipulating the money supply, the Federal Reserve. We're just creating another bubble. The crash is going to be harder. We shouldn't have so much government intervention. Then as soon as he gets into office, we have the largest peacetime deficits in U.S. history. We have nationalization of the credit markets. We have government ownership now through bonds of industries and of companies. That's more socialism. We have universal basic income through the unemployment insurance. And so everything that Obama had been doing was really just what Bush had been doing from an economic perspective, just more. And then Trump, he was saying, hey, that shouldn't be happening. That's manipulation, blah, blah, blah. Well, when he got into office, tripled down on everything economically that Obama had been doing. And so we see a pattern repeating itself where in an earlier part of the cycle, you have monetary policy and fiscal policy separated. Monetary policy, from a definition standpoint, is anything that the central bank does to try and manipulate the economy. And it's usually interest rates going up or down. It can also be monetizing debt by printing money to buy debt. And then in some countries, they're allowed to do other things like they have spending power, whereas in the United States, the Federal Reserve only has lending power. Then in fiscal policy, from a definition standpoint, is anything that the federal government does in terms of trying to manipulate the economy. So this would be considered taxing, because that's withdrawing money from certain sectors of the economy. That would also be considered, helicopter money or welfare spending, or just any spending whatsoever that the government does, because that's taking money that it's extracted out of one area of the economy and redeploying it into other areas of the economy. So that's fiscal policy. Another area of fiscal policy would be borrowing, because when a government borrows money, it's borrowing that money from somewhere, and so it's usually going to be extracting it from the economy, because it's going to be savers or retirees or institutions that are loaning the government money through the purchasing of those bonds, and then they use that money that they brought in to spend again into other areas of the economy. So that's fiscal policy. It's withdrawing spending power from some areas of the economy and redeploying it into other areas. And many times it looks like withdrawing money or purchasing power from the entire economy and then redeploying it back into the entire economy. They just take their cut. Now, most times throughout history, these things are separate, and that's fine. They don't really need conjunction. But once you start having these crises start to come together and happen more and more frequently, and they build up to a larger cycle. This is what Ray Dalio talks about a lot, which is big debt cycles. When you get to the end of these big debt cycles, you start to see more and more conjunction between the monetary policy from the central bank and the fiscal policy from the centralized government. And so let's say back in the 90s, right, we had the dot-com bubble burst, and then Alan Greenspan just lowered rates to try and soften the blow from that. There was no coordination with fiscal policy on that. And then that created an artificial credit boom. All that extra new money ran into housing and created a housing boom. Well, that one was even worse. And so at that point, then we started to see some coordination between monetary policy and fiscal policy. The federal government worked with the Federal Reserve and said, hey, instead of just buying government bonds, you need to start buying these mortgage-backed securities, because these are toxic assets. We don't want it to blow up the financial system, because we want the banks to stay, in business. We don't want them all to go out of business. That would be too painful. And so Federal Reserve, print money and buy up all of these toxic assets off of the bank's balance sheets. So there's some more coordination there. And now, if you've been watching the recent, ever since pretty much March or April, if you've been watching any of the speeches that Powell has given anytime he's talked publicly, he mentions almost every time that we need more from the fiscal policy side of things. Almost every time he says the Federal Reserve has lending power, the federal government has spending power. And so what the Federal Reserve does is they print money to buy treasuries from the government. Now, this was something that was supposed to be illegal, because the people, when they were starting the Federal Reserve, the people didn't want the federal government to be able to lend as much money as possible, because they wanted the market to determine how much money that the government could lend, because that would the interest rates would then be at least a somewhat reliable signal on whether the government had borrowed too much. And if you have a central bank who can print money to just loan that to the government directly, then you have an ability for the government to borrow as much as possible, never have to pay it back, because they've got a money printer who's loaning them that money that never has to get paid back. And so there were roadblocks set up in place that said, hey, you can only buy them from the open market. Basically, you can't buy them directly from the federal government. Well, that's basically all out the window now. There are some loopholes that they have to go through, but the Federal Reserve basically does monetize all of the United States government's debt. And any time that old debt matures and they have to borrow more to pay off the old debt, it's just the Federal Reserve printing money to loan that new money to the government. And that's interest-free debt, basically, because any treasuries that the Federal Reserve holds, any interest on that, all the profits get swept back into the treasury. And so the federal government, any debt that's held by the Federal Reserve, is basically interest-free debt to the federal government. And so Powell has been saying, hey, federal government, you need to spend more, because from their standpoint, they're thinking, hey, more centralized control is going to be what can fix this. But the Federal Reserve is saying, we don't have the power to do anything but lend. And so all of the things that all the bond purchases of the junk bonds and the corporate bonds, all the lending facilities that they've set up, those are all special purpose vehicles that are housed at the Treasury. Those are not held directly on the balance sheet of the Federal Reserve. And so it's the federal government that's doing a lot of spending, and it's all financed by the Federal Reserve. So you're starting to see much more coordination between monetary policy and fiscal policy. And eventually what's going to happen is they're just going to become one and the same, whether that is a result of the Federal Reserve note, which we call the dollar now, collapsing, and then a new Treasury dollar coming in and the Treasury becoming the de facto central bank, or whether that's from an opening up of the Federal Reserve Act by Congress and giving the Federal Reserve new mandates or new abilities besides just lending. I don't know exactly what the form will take, but it's becoming more and more clear that the Federal Reserve is pushing the government to do this, because they're basically saying, we're maxed out, we're doing what we can, but we need more fiscal policy, or at least a lot more coordination between monetary and fiscal policy to be able to deliver the funds where they need to go. Because all of the tools of the past, where they're just doing their own separate thing, are becoming more and more ineffective. And so when your manipulation from before fails, your option is to double down and do it even more and more and more until you've rescued the economy at the expense. You've sacrificed the dollar on the altar of keeping asset prices elevated. And so that's why I'm wearing my new shirt called "Cash is Trash," because it really is. And again, this This is something that Ray Dalio got a lot of flack for saying, I don't know, maybe it was about a year ago now. But we're at this place now where at all costs the currency will be sacrificed in order to keep the economy afloat, in order to keep asset prices elevated. It'll still fail in the end because these things get weaker and weaker over time, the effects of them, and so they have to double down, and they'll have to do some sort of merging between the central bank and the federal government, or at least get a lot closer to that. But essentially, it's paper that is going to be sacrificed at the expense of asset prices, and the purchasing power of everybody who holds cash is going to be destroyed. So if you do want this shirt, I just got these new shirts in. They're all in the little shelf that shows up below all my videos. So got a couple new shirts down there if you want to take a look at them. As always, if you liked the video, hit that like button, hit that subscribe button, the notification bell. You guys are the best. Have a great day.